You have an extra $1,000 in your checking account at the end of the month. Do you send it straight to the bank to pay down your mortgage, or do you invest it in the stock market? For decades, the answer was obvious to everyone. Owning your home free and clear was the ultimate finish line. It meant stability. That's the financial advice most of us inherited from our parents. Let's look at Sarah. She hates debt. To her, a mortgage is a heavy weight. Her primary motivation is emotional security. She wants to eliminate that mandatory monthly overhead as fast as she can. Then there's David. David doesn't care about the emotional weight of debt. He cares about the math. His primary motivation is optimization. He wants to maximize his long-term net worth through market exposure. Both paths are responsible, but after 30 years, the simple choice of where they park that extra cash determines how much wealth they actually get to keep. To prove this is a fair test, we start with identical financial profiles. Sarah and David are 30, signing a $400,000 mortgage. The interest rate is locked at exactly 4% for 30 years. Both have an extra $1,000 of disposable income every month. Sarah applies her $1,000 directly to the principal of her mortgage. David makes his minimum required payment to the bank and automatically drops his extra $1,000 into a broad index fund. Neither of them are going bankrupt here, but by the end of the experiment, their net worth will be determined by the difference between saving interest and earning it. When Sarah aggressively pays down a 4% mortgage, she is effectively locking in a risk-free 4% return on her cash. Every extra dollar she sends the bank avoids 4% in interest. David is taking a different route. By investing in a broad stock market index, he is exposing his cash to a historical average return that usually hovers around 8 to 10%. This creates what financial planners call the spread. If the market returns 8% and the mortgage costs 4%, David keeps the difference. That 4 to 6% gap is where true wealth is generated. This chart tracks their progress over a 30-year timeline. Sarah's aggressive $1,000 overpayments destroy her principal balance. Watch her mortgage drop. She owns her home outright exactly at year 15. Over that exact same period, David's $1,000 monthly investments compound. They start slow but accelerate in the later decades, crossing the $1 million threshold by year 30. By ignoring the spread, Sarah bought guaranteed peace of mind. The cost of that safety was surrendering decades of exponential market growth. Let's shift away from how fast the money is growing and look at how accessible it actually is. What actually happens to Sarah's cash when she pays down that principal? This is illiquidity. On paper, Sarah's net worth is rising, but her actual cash is entirely trapped inside the physical structure of her house. If Sarah faces a severe medical emergency or a sudden job loss, she cannot use her drywall to buy groceries or pay her utility bills. To reach her own money, she would have to go to a bank, apply for a home equity line of credit, and pay new interest rates, or sell the home entirely. By chasing the safety of a paid-off home, Sarah inadvertently created a new risk, having a high net worth on paper, but zero accessible cash in a crisis. There's another force at play here. Most people see inflation strictly as an economic penalty, but if you hold long-term fixed-rate debt, inflation actively works in your favor. This chart breaks down a 30-year fixed mortgage in real terms. The monthly payment amount never changes, but the actual purchasing power of the currency used to pay it drops every single year. By year 25, David's monthly mortgage payment is going to feel significantly lighter than it did in year 1 because he is paying the bank back with devalued dollars. This only works if David's wages increase over his career to at least match the pace of inflation. When you rush to pay off a fixed loan early, you are doing the bank a favor. Sarah is returning high-value dollars to the lender today, instead of letting inflation erode the true cost of that debt over 3 decades. On a spreadsheet, David's strategy is flawless. The flaw is that spreadsheets don't experience human emotion. Over a 30-year timeline, David will have to endure severe market crashes, watching his portfolio lose value without panicking. He also faces the risk of lifestyle creep. David needs the discipline to invest that $1,000 every month, rather than buying a nicer car or booking a bigger vacation whenever he gets a raise. If David panic sells during a crash or stops his monthly contributions, his mathematical advantage disappears. If he breaks, Sarah wins by default, simply because her house acted as a forced savings mechanism that required no discipline. Fast forward to the end of the 30-year timeline. We can finally check the scorecard on their decisions. Sarah paid off her house at year 15. She started investing her extra cash afterward, but she missed the best years of compounding. She finishes with a paid-off home and a much smaller liquid portfolio. David paid his home off on the normal 30-year schedule, but because his compounding was never interrupted, his column shows a significantly higher liquid net worth. Sarah still achieved an emotional win. She lived for 15 years without the stress of a housing payment. That gave her career flexibility and a peace of mind that math simply can't quantify. The mathematical winner is David, but the psychological winner depends entirely on what lets you sleep at night. Making the correct choice for yourself requires plugging your own numbers into a specific formula. This diagram shows how to navigate it. You should be Sarah and aggressively pay down your house if your mortgage rate is high, anything above 6.5% or 7%. Even with a low rate, if you are within 5 years of retirement, paying down the house is likely the right move. You need to reduce your mandatory monthly overhead before your income drops. You should be David if you hold a low fixed rate under 5% and have decades left before retirement. The math says to invest the spread. But that path requires the psychological stomach to ignore market crashes and avoid lifestyle creep. Whether you choose to be Sarah or David, the outcome depends on the math of your own mortgage and your own timeline. Running those numbers is the only way to know if the advice you inherited still works today.